What is a credit rating outlook? Have you ever wondered how investors gauge the financial health of a company or government? One key tool they use is the credit rating outlook. So, what exactly is a credit rating outlook? It is a forward-looking assessment provided by credit rating agencies. This outlook indicates the likely direction of a credit rating over a medium-term period, which typically spans 6 months to 2 years. The outlook reflects the agency's view on whether the creditworthiness of an issuer, such as a corporation or government, is expected to improve, deteriorate, remains stable, or is uncertain during this timeframe. There are 4 main types of credit rating outlooks. First, a positive outlook suggests a high probability that the credit rating will be upgraded in the medium term. This is assigned when favorable developments are expected to strengthen the issuer's ability to meet its financial obligations. This can boost investor confidence, making it easier for the issuer to raise funds. Second, a negative outlook indicates a higher likelihood that the credit rating will be downgraded. This happens due to adverse developments that could weaken the issuer's credit profile. Investors pay close attention to this because it can signal potential risks in their investments. Third, a stable outlook implies that the current credit rating is likely to remain unchanged. This means minimal expected changes in credit risk over the medium term. It gives investors a sense of security, knowing that the issuer's financial situation is steady. Lastly, a developing or evolving outlook is used when the future direction of the credit rating is uncertain. This could be due to conflicting positive and negative factors. It signals that the rating could be upgraded, downgraded, or maintained depending on how these factors evolve. It is important to note that credit rating outlooks are distinct from credit ratings themselves. While a credit rating provides a current opinion on credit risk, the outlook gives insight into potential future changes based on ongoing financial trends and economic conditions. An outlook does not guarantee a rating change but signals the agency's expectations if current trends continue. In the context of capitalism and market efficiency, credit rating outlooks play a vital role in price discovery and risk assessment in financial markets. They provide investors with transparent, standardized information about the potential trajectory of credit risk. This helps allocate capital efficiently. By signaling possible upgrades or downgrades, outlooks influence investor behavior, borrowing costs, and capital flows. Companies and governments closely monitor their credit rating outlooks. A positive outlook can lower borrowing costs by attracting investors seeking safer investments. On the other hand, a negative outlook can increase the cost of capital or restrict access to funding. This mechanism incentivizes issuers to maintain sound financial practices, aligning with market discipline. In capitalist market structures, where competition and transparency drive efficiency, credit rating outlooks serve as a predictive tool. They help investors and market participants make informed decisions, contributing to the dynamic adjustment of market prices in response to changing economic realities.